Welcome back to Morning Trade Live. We focus on the big picture ahead of the opening bell. Michael Purves is with us, CEO of Tallback and Capital Advisors, to talk about this market. I was saying how we're coming up, we have this V-shaped recovery. In fact, we're 2-3% from the all-time highs. What do you make of it?
It's been really striking here, right? You know, this rally off April, I think I certainly saw a rally coming, 5,300, 5,400, maybe 5,600, but the last 400 points have frankly confounded me here. I think it's important to recognize, look, sometimes when the fundamentals are hard to diagnose and analyze, sometimes you just have to really look at technicals. And the technicals really have been really pretty bullish. Now, I do think some of the momentum is fading there. That's purely technicals. When I step back and look at the fundamental situation, we're trading at the same PEs that we were in January. Bond yields are reasonably close to where we were in January. There's a couple of key differences here, though, Nicole. One of which is that the earnings are really pretty much the same. And we're almost halfway through the year here. So you go back a year ago, at this point a year ago, we had a great rally, of course, in 2024. Earnings for the SPX were up 6%. At this point, they're up like basically 0% right now. So that's one
not
thing.
Not great, right?
That's great, and part of that might be because
but not necessarily so great because they weren't as good as they used to be.
Right, no, that's what I'm saying, exactly. So I think the question going forwards is 22 times big round numbers what we're trading at on the SPX market cap index. That works if and only if earnings can really gain momentum in the second half and into 26. And I'm very skeptical of that.
Right, so you are skeptical. We've had an incredible run up, even more so than you thought we would. Do you think that we go back and retest the low levels, the 4,800, 4,900 or so?
I think there's a very good case here to where you can get below 5,000 on the SPX without a recession here. Right. So in other words, if we just have our multiples re-rated down to 18 to 19, and we get our earnings growth down to low single digits, those numbers will square up to somewhere in the mid to high 4s.
Is that a buying opportunity if we get back down there?
Probably.
Yeah.
Absolutely. But the other point I would make is that we had a lot of volatility, very sharp V, down and back up. What I think what we're in right now is we're transitioning from sort of the very fast-moving situation with all the policy announcements to a lot of very slow-moving data. So if we do go back down below 5,000, it's going to be a slow, meandering, very nuanced path down. I don't think it's going to be a shock down where everyone wakes up. The data is degrading, economic data is degrading, but at a slow pace. I think it's a pretty consistent degradation, but it's slow. Same thing with earnings. We're not really, quite seeing that there. So
I do want to ask you about investors, advice for investors. You talked about a lot of the momentum being technology, and you have some notes about rates and the dollar, but just staying on equities, what's your advice for investors now? Is there certain sectors or things to get into to still make money?
So I'm skeptical, as you know, about the broader market here. But having said that, if you were going to have $100 into the market, where I would be allocating to, frankly, is the Mag 6, the big tech stocks. I think those are... Who
are you leaving out?
Tesla.
Tesla, okay.
Yeah, there. But the other guys, I think, are, that group has seen the most significant PE contraction this year. They're the only major group to see their earnings actually increase. That's healthy. And I think they're also going to survive whatever storms from tariffs better than a lot of U.S. cyclical value. So that's on the U.S. side. Now, for the other part of that $100, I actually think Europe is a much better place to own cyclicals and values than the United States. So you're still into Europe.
I mean, we've seen Europe doing well. There are some people who started to get a little nervous. Others who still think that Europe is the place to be.
Look, I would say relative to U.S. cyclicals and value, if you're, again, I'm sort of cautious about risk assets like equities broadly. But if you want to think about, if I'm going to own cyclicals, it's going to be in Europe, not in the U.S. right now.
And then when you think about the rate environment and the dollar, I do want to get your advice for investors, but what do you think is happening here?
Well, I think, so we talked about the 10-year being back where it was in January.
Yeah.
The term premium, the yield curves are also pretty similar to where they were in January, but they're So the numbers are all the same, right? But there's a major qualitative difference between today's 10-year yield and back then, which is that the 10-year is selling off really in concert with dollar weakness as opposed to dollar strength. So when the 10-year yield it went higher back in December and January, dollar was rallying. It's obviously been weakening quite a bit over the last several weeks. That's not a good rate sell-off here, right?
Do you really think that the dollar can be replaced?
No, I don't.
mean, there's a lot of talk about that, but you need so much coordination. I've had some great conversations with some very high-level people, even the BRIC nations. The coordination, they're trying, but it's so far gone, like to try and replace the dollar.
No, I don't think the dollar will be replaced. It will stay the reserve currency there. Having said that, there's a lot of dollar assets are owned by foreigners. And what you are seeing here is a slow, steady retreat from owning some of those dollar assets, portfolio reallocation, right? And that is also, so that's, you're really seeing that in the 10 and 30-year treasuries, those yields getting pushed up. And again, getting pushed up for the wrong reasons there. If there's a buyer strike on the back end of our curve, that makes a price earnings multiple.
I mean, there was concern that Japan might get out, a lot, and because that they could invest in other ways. I mean, they could invest in our technology or our energy, but that they may get out of U.S. treasuries.
Right, exactly. Well, just the central bank of Japan owns $1 trillion roughly of our treasuries.
Right.
Now, a lot of the treasuries that the central banks, the foreign central banks own, are more on the short end of the curve there. But you also have giant life insurance companies in Japan or elsewhere that own the back end, right? And that's really where I think more of the friction's going to come here. So again, I don't think this whole thing is like some big binary, oh my God, the dollar's collapsed and we're being replaced. But if you start seeing this correlation breakdown of rates with U.S. interest rates with our dollar continue to be, that correlation keeps breaking down the way it does, and we look more like an EM type dynamic, that's going to be very problematic for U.S. equities.
There was concern too that with all the tariffs and everybody was so fearful because that first board that came out, Liberation Day was insane. People were like, oh my goodness, those tariffs seem insane. We've since seen a lot of negotiations happening, but there was concern that the U.S. in the tech space would fall behind in a big way. Do you feel that that's true or no? Because you're seeing the CEOs meeting with the administration and more investment in the U.S., in fact.
Well, I think let's zoom out for a second, because let's assume there was no tariffs at all. There's still a secular story that the China tech story is really gaining a lot of steam here across a lot of different parts of technology, from biomedicine into energy transition to EVs to AI, right there. When you add on tariffs, I mean, there's a lot of intricacies going on right now between China needing chips and we need rare earths and all that kind of stuff. It's all sort of related here. Look, I wouldn't bet against U.S. big tech here. I think they have enormous balance sheets and enormous intellectual capital to push and drive their way through these things. I do think that I don't think the administration's well served by creating incremental problems for them, because that race with China on technology is a real race. It is heating up here, and we want our tech guys strong.
Okay, well, we have talks with China, we have CPI, PPI, consumer sentiment, Apple. We have a big week ahead. Michael Purves, thank you for helping to set us up on this Monday of Talbach and Capital Advisors. CEO there, Michael Purves.